Now, with more analysts saying the effects of China's slowing economy could be more serious than originally thought, countries dependent on Chinese imports are on high alert. And recent data projects that Korea will be the third hardest hit if demand from China continues to fall. Kwon Soa has the details.
China's imports fell 14.6% in the first 7 months of the year from the previous year. What already had a huge impact on countries intimately tied to China could bring about further dark clouds in their economic growth if demand from China stays at such low levels or even drops further this year. According to an analysis by The Guardian, New Zealand and Australia would be hit the hardest. In case of a near 15% drop in Chinese imports, the GDPs of New Zealand and Australia would drop by 1.9% and 1.7% respectively. Korea, which exports around a quarter of its outbound shipments to China, would be the third most affected country with a 1% decline in its GDP and a loss of almost $13.9 billion in exports. Although China imports the largest amount of goods from Korea, the proportion dropped by almost 1% from January to July. Another risk factor would be a further depreciation of the Chinese yuan. Oxford Economics says that if the yuan's value falls by another 10%, Korea's GDP forecast for next year would drop by 1.16% and exports by a little less than that, as China's price competitiveness would increase. To make matters worse, Chinese major banks have seen their worst half-year profits in more than a decade, with 3 of its 4 largest institutions posting negative growth in the second quarter of the year, raising fears in financial markets about developing countries closely connected to China. Experts say Korea will have to brace itself for more risks from China with new policy measures such as a cut to its key interest rate. Kwon Soa, Arirang News.